All right, you're taking a look at a live shot this Friday morning of the opening bells on Wall Street. I'm Yahoo Finance Executive Editor Brian Sozzi, and this is Opening Bid. Here on Opening Bid, we bring you the investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make decisions with your money. All right, the market has been on fire this week, of course, so let's send it right down to Yahoo Finance's Ali Canal at the Nasdaq in Times Square. Ali, the team tells me you are out there record hunting on this Friday morning.
I am, Brian, because yesterday I was all excited to get a record for the S&P. We closed just shy of 3 points from that record. But currently today, as markets are opening up, we are trading above those record highs. 6144. That's the number that we need to beat. So if these gains continue to hold through the close, we could have a new record high for the S&P 500. The last time the S&P 500 hit a record was back in February. Also on record watch for the Nasdaq Composite, trading in that record territory. But all three major indexes opening in the green today. Now, speaking of records and individual movers, Nvidia is now above $156 a share. That's another record. We've seen record closing highs for this company throughout the entire week. So potentially we could be ending the week again on a literal high note there for Nvidia. And strategists have told me that currently at these pricing levels, the company might be undervalued. So potentially more room to run there. And then quick check on Nike. This is something that we're going to be talking about, Brian, a little later in the show here, but we are seeing shares up 13% at the open. We are trading right around $71 a share here. Now, heading into today, the stock was down 17% year to date, but with these gains, we are now down only about 6%. So lots to get into there with Nike.
Investors just doing it on Nike. I can't help myself, Ali. That's just what I do. All right, we'll be back to you in a second.
I love it.
All right. We're kicking things off today with your daily guide to the biggest market drivers of the trading day. Here's what I'm watching. Number one, Nike stock is ripping as its turnaround plans under new CEO Elliott Hill begin to take shape for investors. So much for that $1 billion tariff hit they called out in the earnings call last night. Number two, the Trump administration is touting a new China trade deal and teasing several others that are nearly closed or could be closed on that July 9th deadline as it approaches. A Trump administration official tells me this is not a new trade deal, just a reaffirmation of the one outlined in Geneva a few weeks ago. And number three, we bring our biggest takeaways from the market in the first half of the year and serve up our hottest predictions for the second half. Here to break it all down, Truist Co-Chief Investment Officer and Chief Market Strategist Keith Lerner, and Yahoo Finance's Ali Canal is joining us again, and our very own Inez Ferre. Fabulous panel here on this Friday morning. Keith, I'm going to go to you. You heard Ali talking at the top of the show about these record highs. Simple question, or maybe not so simple. Can this continue, or might we see some hiccups in the back half of the year?
I certainly think we're going to see some hiccups along the way. I mean, there's still a lot of uncertainty around the Fed, trade policy, the path of the economy. But with all that said, the big picture is we've been moving sideways for 7 months. We're just breaking above to the upside of that range. Tech just did it. If you look at some of the sentiment data, it's still not showing a lot of optimism. So I think you're going to force more investors in as we move higher. But again, I mean, we had a lot of hiccups in the first half. We're still somewhat positive. I expect that we're likely to move higher in the second half, but also expect some bumps, probably not as severe as the bumps we saw back in April, though. Ali, I was reflecting a little bit on this Friday morning. Some of the things that I learned in the first half in investing, you're always learning something every day. If you're not, you're probably becoming a worse investor. I was reminded of Nvidia. Now, you've been talking Nvidia all week long. This stock is almost indestructible. Let's keep in mind, late April touched a low of in the high 90s. It's now at $156, and people are thinking it could double from here still.
Yeah, people think it could double. They see around a $6 trillion valuation. Right now, we are just below $4 trillion. So there's a lot of momentum here. And I think that just speaks to the broader market at large. Momentum chasing. We saw a lot of buying of the dip earlier this spring. And retail traders, they just want to continue to get involved in this market. And it feels like we are on the precipice of a big opportunity here for the S&P 500. We are past peak uncertainty. I think that was the main concern in the spring, especially after Trump's Liberation Day tariff announcement. But at this point, we just have a lot more clarity on that front. The trade deal with China. China is one of our biggest trading partners. This is probably the #1 country that investors were looking at when it comes to the announcement of some of these trade deals. And the fact that that's happening before the July 9th deadline, I think is just adding more conviction to this market. At the same time, we've seen various fundamentals really hold up. We had a pretty strong Q1 earnings season. We have an economy that's chugging along despite some hiccups along the way, like we've been talking about with, inflation being a little stubborn, and then the labor market has seen some cracks, but we still have an unemployment rate at 4.2%. This is historically low. We will get an update on that next week. So a lot for the Fed to digest, but for now, it just feels like we are at a very solid place in this market rally.
And as you've covered the oil markets very closely for us, what was your takeaway for the first half in terms of oil?
Yeah, look, oil is back below those levels before the Israel-Iran war. So analysts are expecting that oil prices this year will be lower than last year, and next year they will be lower. So this bodes well when it comes to inflation. Yes, we did see volatility. Yes, we have seen this temporary spike with oil prices. But nevertheless, you are expecting that there's enough oil in the world right now. That's the call that analysts have been making.
Is there enough oil, Inez? Come on, you're not a big believer in peak oil?
No, there is plenty of oil, and more countries are getting are pumping as much as they can. And OPEC also has been increasing its production. There's tons of spare capacity there. So you have enough oil. It just is a matter of supply shocks, whether or not this Middle East conflict flares up. But nonetheless, this bodes well for inflation.
And as I don't share your view, I mean, there's only so many dinosaurs on the planet. Eventually, we will run out of oil. But let's get to some predictions. I'll serve up my prediction in case Keith wants to make fun of me for it. I think Bitcoin is going to 150,000, up about 40% from current levels in the second half of the year. Keith, I hear a lot of institutions getting involved with Bitcoin. I see a lot of this stablecoin news. Of course, the legislation last week. I see MasterCard getting into the space. There just seems like there could be a big pop in all things crypto in the back half.
Yeah, well, do you want me to comment on the Bitcoin side, Brian? It's hugely moves on sentiment in general, and technically it looks pretty strong, but I really don't know what the value of it is, so it's hard for me to say that. But as far as are you looking for a prediction, Brian, for me for the second half?
Surprise me, Keith. Prediction-wise, yes.
Yeah, I don't know that I have some big overall prediction, but maybe in the second half will be somewhat less volatile than people think as markets start to focus more on some of the things they were thinking about late last year, right? Deregulation, inflation coming down. At some point, the Fed likely cuts rates as a whole, and maybe things become a little bit less tense than what people probably are braced for after such a difficult first half.
Ali, over to your prediction. Hit me.
All right, Brian. Well, I love my hot takes here. So I think the Fed is going to stay on hold until December. I don't think we are going to see that first cut until December. And because of that, I'm going to predict that markets will be a little volatile through the fall. But by the end of the year, we're going to have this Santa Claus rally. And I think the S&P 500 is going to end the year 10% higher.
And as let me guess, prediction for you is that we're going to get more dinosaurs and oil prices are going to plunge to $20.
My prediction is that we are going to see gold back above its high of 3,500. And this is because central bank buying, the Fed, I believe, is going to lower rates before December. So I disagree with Ali on that one. And you do have the wild card of Trump. And I know that the China trade deal is yes, that's huge. But you never know what's going to happen in the second half of the year. And perhaps some stagflation risks as well. So my prediction is that gold is going to go higher.
Ali, you want to fire back at Inez? 15 seconds.
All right, well, here's what I think about the Fed staying on hold. I think the labor market is going to continue to be strong. I think we're going to have a strong labor market next week. unemployment rate's going to still be at historic lows. So I don't think the Fed's going to move from there. And I think a lot of those risks that we saw in the first half of the year, they're going to be pretty much disintegrated, I want to say, by the second half of the year. So I think it sets us up for a strong second half, but I do think that we could see some choppiness along the way.
I appreciate the friendliness. Let's switch gears here. Let's get over to Nike. Like I mentioned at the top of the show, guys, this wasn't a great quarter by Nike. Sales down 12%. If you go into that earnings call, pick it apart piece by piece. Their classics business, which is Dunks, Air Force One. Keith, I know you're a big fan of those sneakers. That business down 30%. And I think the market is just sending Nike higher on this expectation that the second half of this year, it's going to have a good holiday season. But Keith, a lot has to go right, I think, for the consumer. We'll get into the Nike aspect, but a lot has to go right for the consumer in this country for a company like Nike to justify this move we're seeing here in the morning.
Yeah, well, markets are all about expectations. I would say expectations heading into this report are relatively low. That's why you're seeing such a big bounce. And, I guess the question becomes that you're seeing the consumer and some weakness in some areas, especially the low end, but they're still willing to pay a premium for something, where they see value or there's a story to it as well. So I think what we'll see in the second half is this continued split between the haves and the have-nots. But I'm not really surprised by the magnitude of the mood, considered how how negative the sentiment was headed into this report.
Ali, Nike outlines a potential $1 billion hit from tariffs that the market is totally shaking off.
Yeah, I think that was the probably worst case scenario there, that $1 billion hit. And now that we have these positive trade developments, a trade deal with China, that's a good thing for Nike. And they already were diversifying their business away from China. Elliott Hill on the call, he said that it's time to turn the page, that its turnaround plan is beginning to take shape. They've seen progress on the inventory front. And heading into this report, it was really downbeat. But I did say on this show the other day, Brian, that there was some optimism on the street.
Oh, are you touting your calls? No, you're not a financial media pundit, Ali Canal. What is going on here?
I'm just saying that potentially the worst has been priced in from the stock. This wasn't a good report. However, I do think it was a better than feared report. And moving ahead, I think we could see, a move higher. And clearly today, that's what investors think.
Now I'm going to have
to
start whipping up a spreadsheet to track your calls, Ali Canal. All right, well, hang with me there, team. And of course, if you have big predictions on the market for the second half of the year, get at me at Brian Sozzi on X. I would love to absolutely hear them. We'll be right back with more Opening Bid. Welcome back to Opening Bid on this Friday morning. Let's get a quick check of these markets. They've been hot all week. Let's see how they're coming out of the gate here. Well, you can see there things are staying hot. Dow is up more than 200 points. The S&P 500 and Nasdaq also higher. Nvidia is still trading near a record. A lot of other stocks in this market also continuing to trade at a rerecord. I would encourage you to check out the 52-week lows too. You're still seeing a lot of, not every company, I guess, is participating in this rally. You have like a PepsiCo trading at a 52-week low. So not every stock is ripping higher. All right, let's now turn to our stocks of the day. Not stocks, stocks of the day. Oh, yes, you're getting bonus stocks because it's Friday, friends. While you have been paying attention to Nvidia's record highs this week, JP Morgan and Goldman Sachs are also at all-time highs as well. The drivers, you ask, even if you didn't ask, I'm going to tell you, no signs of a rate cut from the Fed, more volatility in the market, and likely easing financial regulations. Veteran bank analyst Mike Mayo telling me this morning he's still bullish on the banks in large part because of easing capital requirements. Jumping into the Yahoo Finance platform, I find it interesting. You see the platform right there that JP Morgan and Goldman Sachs still trade at a discounted forward PE ratio versus the broader market. Given all these tailwinds, they do still trade at the historically relatively high price to book ratio. A lot of wonky stuff there, but all very important for making investment decisions. Still with me is Keith Lerner, Ali Canal, and Inez Ferre. Keith, well, the good thing about having you here, amongst many reasons, you actually work at a bank. So help us understand what the market might be seeing in some of these big bank stocks.
Yeah, well, first of all, I think it's a good sign that you're seeing these big banks break out to new highs. That's not something you typically see right before a recession. And I think what you're seeing is, one, you're seeing a steeper yield curve. That's a positive. I think the M&A and IPO market was pretty much shut down in the first half. That's starting to pick up. That should accelerate in the second half as well. Eventually, we do think that the Fed likely cuts rates in the back half as well. And then the big part, as you already mentioned, is the deregulation part as well. So it is mixed somewhat within the sector, but especially with more volatility as well that you've seen it is certainly good for some of the larger financials. And again, a good sign technically that they're leading. The broker-dealer index just broke out.
How should investors, Keith? Let me just stay on you for a sec. How should investors value these stocks? You heard me right there talk about the P/E ratios. It's trading at a discount relative to the broader market. Price to book is still relatively high. I was looking at a good note from R.W. Baird this morning, noting that J.P. Morgan's trading at record high valuations. Should investors just ignore that and ride this momentum because we are going to get easier regulations?
Well, I wouldn't ignore them, and those high valuations may suggest the upside will be maybe somewhat constrained over time. But I also think you have to remember, coming out of the financial crisis, the capital ratios are a lot higher. The financial system's a lot stronger as well. So I think a lot of these financial companies are in a better position. So depending how far you're looking back, it makes sense that they're trading somewhat more at a premium valuation. And there's also the overall market's trading at a more of a premium valuation. So it makes sense that that you'll see some follow through, and you're actually seeing those higher quality names that investors have more confidence with, have that premium, which to me makes some sense.
And as Keith mentioned a good point on volatility in the markets. I'm thinking through what we've seen in the oil markets. I'm seeing what's happening in the crypto markets, and you would have to think, those second quarter earnings calls for the big banks, they're going to really hype up to how that volatility is shaping their bottom lines and how it could continue to shape the bottom lines in the back half of this year.
Yeah, no doubt. But as Keith was alluding to, I mean, this is very good for the banking sector in general. The fact that we are seeing now, we've seen peak regulation when it comes to banks. So these stress tests are expected to come in in putting banks in a very favorable light. I was struck by the fact that expenses, regulation-related costs from one of the analyst notes this morning are estimated at 20% of the total bank expenses. So this is going to free up a ton of capital. But as you mentioned, yes, we've seen volatility in different areas. One thing I will mention about crypto, it is going to change the way financial services are done in many aspects. Just one note on the stablecoin, which I know that you know that I've been covering quite a bit. Stablecoins is going to be very, very significant when it comes to these stablecoin issuers are big buyers of short-term treasuries. This is going to be huge. This gives incentives for the government to work alongside stablecoin issuers. So this is going to sort of revolutionize the financial sector. And
you can type in Inez Ferrer onto the top of Yahoo Finance in that search bar. Read all the work because it's really good stuff on all things crypto. Ali, you're in the zone today. Last 30 seconds. Do you have a big call on the banks? Why not just throw caution to the wind, right?
Yeah, you talked about that note that you flagged, Brian, from Baird, and they did waive caution on some of those mega cap names. J.P. Morgan, they downgraded to underperform. Bank of America to neutral. Not because they are bad banks. They have fortress balance sheets there, but because they're just too expensive, as we've been discussing with these valuation concerns. JPM in particular trading at record valuations here with limited upside, according to these strategists. And they argue that regional banks may be the better play here. Now, regional banks, they've just been so beaten down here, but the risk-reward scenario just looks a bit more attractive on that front. So maybe we could see this big rebound here in regional banks, but I do agree with Keith that those high-quality names, probably within this market that's very prone to headlines and volatility, you want to be focused there.
Good stuff, y'all. Keith Lerner, always good to see you. Appreciate you in that Yahoo Finance purple tie. Ali Canal with her big calls. Inez Ferrer, great oil analysis. Have a great weekend, y'all.
Thanks, Brian.
All right, now for today's Power Player segment. KPMG reports that cost-conscious consumers are expected to spend 7% less each month on restaurants this summer. This pullback, paired with ever-changing tariff policy, has created concern for fast casual restaurants and snack brands. But McCormick, a distributor of spices and condiments such as Frank's Red Hot Sauce, yes, I do use that stuff on everything, reiterated its full-year guidance this week after growth in its consumer segment exceeded expectations. Joining me now is McCormick CEO Brendan Foley. Brendan, always great to get some time with you now. I'm an avid reader of earnings calls. And off the jump on your call, you mentioned that Americans are eating more leftovers to save money. Is that what we're really looking at here in terms of the economy? Is that the economy you see, that we're in such shape that we're eating leftovers instead of going out there and buying a new steak to season with Montreal steak seasoning?
Well, Brian, it's good to be with you again. Really, there's more going on than just, consumers focusing on leftovers. Really, we see a big convergence right now in consumers seeking value, but also health and wellness. And it's really creating a lot of growth opportunity for McCormick. especially in our consumer business, but I would also say on our flavor solutions business. We do see consumers looking for value. They're buying larger sizes. They're making more trips to the grocery store, maybe putting a few items fewer in the basket, but largely they're still exploring with flavor, and they still need flavor every day. They're going to the perimeter of the grocery store more often to buy more protein and produce because they're making more meals at home.
I heard the consumer looking for more value. I heard that from General Mills earlier in the week. Disappointing quarter for them, different versus McCormick. They're seeing pressured sales of cereal, but what does value mean to you? And if the consumer is leaning into value, what have you had to do at McCormick? Have you had to cut prices, come out with smaller package sizes? How are you adopting to the consumer?
We're looking at a range of opportunities when we think about value for the consumer. So we've looked at what one would call price pack architecture to make sure that we have price points and sizes available for all ranges of value that consumers are looking for. And so that's been pretty successful for us. But even last year, we implemented a plan called price gap management in order to really identify some of those items that were more elastic and they needed sharper price points. So we even brought some prices down on a number of items to make sure that the value was right, was there for consumers. And that's really been doing a lot to help really drive our business and make it more volume led. But at the same time, we're launching more innovation, we're putting on more brand marketing, and we're getting even more distribution across our business because we're driving the category.
Brendan, of course, you make a good chunk of your products right here in the United States, but the ingredients in many cases that you're using in these products are coming from various locations overseas. How much of a tariff headwind is your business experiencing? I'm thinking back to what Nike said last night. They're having a $1 billion hit from tariffs. Now, of course, you're not Nike, but there has to be some form of hit here.
When you think about tariffs, you're right. Over 90% of the items that we sell in the United States are made in the United States, but a great majority of the agricultural ingredients that we need are sourced from outside the United States, mostly because they can't be grown here. So we're focusing on what we can control. And a lot of our focus right now from a tariff impact perspective is on agricultural ingredients. And so far we've been able to mitigate most of that for 2025. And that's been, through a series of, just productivity initiatives and that's been helping us to really mitigate overall tariff. But that's, as we said in our call yesterday, on an annualized basis, it's about $90 million. But just for 2025, we saw it was at 50 million, and we've been able to figure our way through that, at least for this year.
Brendan, you also talked about, and details of this are still coming in, and you acknowledged on the call, on Texas, and new warning labels for food additives. How much of a shakeup will what we're seeing out of Robert F. Kennedy and his administration or his team, how much of a shakeup is that causing to companies like yours and the food industry at large? I mean, you're very much a veteran in this space.
We work with our partners in the Consumer Brands Association and other companies to really advocate for if there needs to be a policy change or regulatory change, let's do it at a national level. When things happen state by state, that becomes pretty disruptive in terms of how a food company would then think about doing business at a national level. So whether it's states like Texas or West Virginia or whatever it might be, we're really going to be advocating for taking this conversation to a national level. That's way more productive, I think, for everyone involved.
Do conversations like this, though, Brendan, raise the cost of doing business for a McCormick?
No, we don't see it as raising the cost of doing business right now. What we're seeing, overall, just cost pressures, just broadly, that has been happening throughout the business. You probably heard in our call yesterday that beyond tariffs, we are seeing some cost pressure come through just because of the uncertainty in the marketplace right now. Most people are just not willing to really make an adjustment or a move based on typical supply and demand dynamics. And so that is having a little bit of increased cost pressure. And as we acknowledged in our call yesterday, we've seen some of that come through.
And Brendan, we're coming up on barbecue prime time in July 4th. Now, French's mustard is one of your brand. I mean, I use it on hot dogs and various things. What does demand look like for you ahead of this key holiday? And the surgical price increases that you talked about on the call, does that include things like mustard and hot sauce that will be used on July 4th?
Well, first of all, we think we're going to have a terrific grilling season. It's off to a really fast start. And we're seeing consumers really look at our category performance overall. The grocery stores are seeing a lot of growth happen with herbs, spices, and seasonings, and also condiments and sauces. And so we still see a lot of growth happening in our categories across the year. As it relates to pricing in surgical, we have still the benefit of a lot of our price gap management programs that are in place. But also, we won't see any impact really on that surgical pricing happen until the fourth quarter.
All right, we're going to leave it there. McCormick CEO Brendan Foley, enjoy your fourth, and we'll talk to you soon. All right, coming up, Yahoo Finance's Market Catalyst. You won't want to miss it.